Good evening, everyone. Thank you for your time this evening to hear the story of PCF Bank. I'm Scott Maybury, I'm the CEO of PCF. We're an AIM-listed specialist bank. We've only been a bank for 20 months, or open as a bank. We were authorised at the end of 2016, so it's been a very exciting journey for the last 2 years as we've delivered on our strategy of growth and scale, supported by the retail deposit market. As I said, specialist bank, AIM listed, we're actually the only bank on the AIM market. And as I said, authorised in 2016, opening the doors to savers in 2017, July 2017. We have 4 business lines. The first 2 of those business lines are our traditional business lines, which we actually had ahead of becoming a bank. So we're a successful financial services company, profitable financial services company, but somewhat constrained by the ability to fund ourselves, particularly constrained by the global financial crisis between 2009 and 2012, when we were wholly dependent on wholesale debt. So we've added to that in the last 2 years with 2 new business lines, and I'll go through each of these business lines later in the presentation. The portfolio at the moment is 276 million. We've got a focus on lending to the prime space of each of the 4 business areas that we operate in. We're supporting the portfolio with 204 million of retail deposits, so they've been built up in under 2 years from scratch, and we've now got just short of 5,000 savings customers. We raise that money on term deposits at fixed rates, so we've got a natural hedge there for both term and for rate against our lending portfolio. And we have a total customer base, including our lending portfolio, of 19,000 customers. We recently raised equity, 10.75 million. We closed that transaction in March this year. We were coming back to the market at some stage this year, but as a board we decided to do that ahead of the 31 March Brexit date. We thought that was sensible, removes any chance of market volatility. Certainly if we hadn't have been able to raise equity later in the year, it would have stalled our own strategic plan. But we've added to that in our most recent announcement with a 15 million Tier 2 facility, which is to the benefit of all stakeholders in the business, really. It's a facility that can qualify as capital, and it can be drawn down as and when required to support our growth plans in the future. So we raised capital of 10 million back in March 2017. We came back to the market in 2019, giving ourselves a 2-year window really to execute our strategic plan. We had a similar vision today, but with that 15 million of Tier 2 facility, we've really made that a bigger window before we'll be returning to the market and diluting any further. And it gives us an opportunity to work towards our strategic goals, which I'll lay out later in the presentation. Through acquisition and growth, we've grown to 93 staff. We have offices in the city and out in Berkshire. And this year, as a business, we celebrated 25 years in business. As I already said, we were successful in financial services, just a lot smaller than we currently are today. And the shareholder register has 63% support by Summers, who are a Bermudan investment company who specialises in financial services companies. They own the Utilico Emerging Markets Funds in London. They also own Waverton, which is the old J.O. Hambro asset management company. And their stable is largely made up of financial services investments, a long-term holder, and they've been with us since 2012. And our current market capitalisation is just short of £84 million. So we released our interim results last week, very positive numbers and a positive statement to the market. Before I sort of delve into a few numbers for you, the highlights I've been picking out for people. Firstly, this is the first set of results for PCF Bank that has more diversified income flows. We've traditionally only operated in the SME asset finance market and the consumer motor market. We've introduced 2 new business lines, and both of those business lines have made a contribution to this 6 months result. So a diversified balance sheet and diversified classes of assets gives us a stronger business and a range of income flows to grow into in the future. The second thing was the capital structure. I've already mentioned that. I've been pulling that out. Obviously, the putting in place both a Tier 2 and putting in place some additional Tier 1 capital has left us well positioned with capital headroom to be able to execute our plan over the next 2 to 3 years. The third thing is just the numbers themselves, which I'll take you through. And the fourth thing is, in our statement, if anyone has been following us and read it, also a little bit of a word of caution about the economic environment and the collection environment generally in the UK, which won't come as a shock to anyone that knows PCF Bank. I've been very cautious on outlook for the last 2 years, but certainly we're calling probably the top of the credit cycle 18 months ago, I would say. And there's a slide later on that as to how well prepared we are and how well we're set up as a business to accommodate any downturn should there be a downturn. Some of the highlights: new business originations up 75% to 121 million. Our portfolio has grown by 54% in the period. We've already talked about the size of retail deposits supporting that business. We've talked about the equity. The next bullet point down, we've also put in place a 30 million revolving credit facility just to sit alongside the retail deposits. It helps us smooth the deposit taking process. It helps us also smooth maturities so that at no point in time, if we're looking at a maturity of a whole lot of 1 year deposits, for example, you can actually smooth that out so that you don't get peaks and troughs. That facility can be repaid without penalty, so it's ideal to support a retail funding strategy. In the period, we acquired Azul Limited. That's the broadcast and media company, and I'll talk about that a little later. And we also commenced a property finance division operating in bridging finance in the period, with the first transactions being written in January of this year. Of the business we wrote in the first half of this year, 75% falls into our prime credit grades. A number of these prime credit grades we weren't writing before we became a bank because we were excluded from that market because of our price expectations. With a cheaper cost of funding coming from retail deposits, we've been able to move increasingly prime. And I think that strategy will be further supported as we talk through this presentation when you have our take on where the right part and prudent underwriting is a key part of delivering in these uncertain economic times. Impairment charge at 0.9% requires a little bit of explanation. We've adopted IFRS 9 in the period. I won't bore you with the accounting technicalities of that, but a new way of looking at what we would have called bad debt or impairments, whereby you're actually taking in a number of macroeconomic scenarios to actually look at the expected loss from your portfolio rather than the actual loss after it incurs. So that requires a little bit of extra provisioning. Should those scenarios deteriorate, of course, your impairment charge is likely to go up, and should economic conditions, growth and emerging risks improve, your impairment charge would fall. In layman's terms, it's a bit like the general bad debt provisioning you're allowed to take in the past, except now it's got a number of scenarios wrapped around it that you have to justify and that you have to model out. Financial highlights: PBT up 57% to 3.3 million. Operating income up 51% at 10 million. Net interest margin fell slightly, which we completely expect. By moving into the prime space in each of the markets that we operate in, we're obviously taking a lower yield on that portfolio, but you still get the profitability increase through operational gearing and scaling of your business. Earnings per share up 50% at 1.2p. And I guess a pleasing number is to 2 years into becoming a bank, and as you can probably all imagine, the costs of becoming a bank are considerable. So the running costs of a bank are approximately 2.5 million a year, which includes the depreciation costs on systems, the governance and controls and infrastructure you put around a bank. We've largely absorbed those costs in our income statement and kept our cost to income ratio relatively stable. So the costs we are putting into the business are being equally matched by the top line income that we're generating from the business as well. Return on assets is stable at 2.7%. We target 3%, and the average after-tax return on equity at 11.4%, and our near-term target is 12.5%, so we're fairly close to achieving that. Capital ratio, of course, all part of being a bank. Can't disclose what our actual capital ratio is, but that's comfortably ahead of the regulatory requirement of the Bank of England and the PRA. Talking about our business lines, the first two are the business lines that we've operated in for many a year, in excess of 20 years in both cases, well understood by us, an area that's generated good profits for the business through all economic parts of the cycle, and industries that we and areas that we understand very well. So the first one and largest part of our business is SME lending, asset finance lending to small businesses. It's hire purchase and lease for business critical assets, so that can be vehicles, wide range, anything from light commercials through heavy commercials, through coach and bus, yellow construction equipment as well, mobile cranes. And then the remainder of it largely fits into manufacturing and engineering equipment. What you've got consistently across that portfolio is collateral-backed lending. So you're talking about assets that have a good, strong resale value and can be sold into liquid markets as well. The portfolio is 148 million at the end of March. New business originations are up strongly, and the average deal size is just short of £50,000. And that's actually increasing. As we're going increasingly prime, you find those prime customers typically are looking for newer and more expensive equipment. So we've seen that number increase relatively strongly over the last 2 years. That now makes up 58% of our total portfolio. Consumer motor finance, we finance used vehicles, not new. We don't try and take on the captive finance companies within the manufacturer groups who often use their finance as a loss leader to sell the vehicle. We are happily positioned and have always been in the used car space. Our typical product here is somewhere between a 1 and a 3 year old car that's taken its initial depreciation hit. You have a fairly good line through its valuation, and you measure your risk against the depreciated value of that vehicle. Once again, asset-backed lending with very liquid assets, a portfolio of 106 million. As you can see, the average transaction size is a lot smaller, and both of these businesses is sourced through a broker network of intermediaries introducing that business. And across both those products, we don't take any residual risk. So in both cases, you're looking at full payout hire purchase or finance lease, no PCP contracts, no operating lease contracts. We're not taking a position on the value of the equipment at the end of the transaction. And typically, when you're lending between 3 and 5 years on both those divisions, and you're amortizing the balance down to zero, you'll at some point, your amortization curve will drop below your depreciation curve, leaving equity in the asset. So you're becoming more secure in the asset as the length of the loan goes on. And on the right-hand side there, you can see the new business volumes that we have generated. In the half year, we're not far off last year's full year. But what's really pleasing is the top two colours, the light blue and the pink. They're our two new diversifications that we've entered into in the year, making a contribution at new business level, which is great to see. And here are the two new lines. The first one was by acquisition. This is a broadcast and media company who finances broadcast cameras for the TV, film and sports industries, 5G cameras, for example, and the lenses that go with them as well. Very specialised equipment with good resale value, holding their value as well, typically financed over 3 years. Excellent business, has a fairly strong position in its market with about 60% of the market share for what is a niche market. But for us, it's a sizable amount of origination. It originates in excess of £60 million of business a year. And we've actually grown and supported it this year. And the comparative pre-acquisition new business volumes was 23 million against 33 written in the 5 months that we've owned it. What attracted us to we like the asset because we know the asset retains its value and it's in an excellent niche market. But what attracted us was the people who have been operating in this space for 15 years. So they're tied into the acquisition through deferred consideration, employment contracts and share options. But their understanding of the marketplace is key. But the other attraction is it's a diversification for us as well of both income streams because it generates fee income, which is new for our income statement. And it also goes direct to the market. So it moves us away from broker-introduced business. The relationships in that business are directly with the manufacturers and distributors like Sony and Canon. We have the contract for Sony distribution of broadcast equipment right across Europe. So the potential of that business is to actually expand that across the European markets should we wish to do so. And bridging finance, which is a lot newer, first transactions written in January. These is first charge lending against traditional bridging, not development finance, so non-structural changes, so supporting people buying properties at auction or doing small refurbishment projects, also allowing them to maybe finance for a short period while they move on to their next project. Experienced professionals, small businesses or individuals with a track record in property development. As I said, only started writing business in January. It made in the period just short of £3 million worth of advances, and we expect that portfolio by the end of this month to be beyond £8 million. So it's growing quite nicely. And we're targeting to have £20 million of business by the end of this financial year. Achievements for this year are most of them where we've made very good inroads into. Actually, the growth of the core businesses is extremely strong. We've been able to generate growth in the SME asset finance market quicker than the consumer motor, and that's because it isn't just about cost of funds in the consumer motor market, it's also about delivery of service. And we've got a major project going on developing our portal to brokers to actually do straight-through processing for consumer motor. So the great news for the investor in the business is the growth in consumer motor will lag the growth in SME, and that's still to come. So we can still see good growth numbers coming out of both our older and more core divisions. Diversify the balance sheet. We've delivered that through acquisition and organically through the bridging property finance operation. And we've also put in place additional infrastructure, new IT systems, large increase in people as well. We're effectively a year ahead of where we said we'd be at this stage. If I had been here last year, I would have been talking about a medium-term target of the 350 million portfolio. We're at 276, so we've moved on to our next target, and I'll speak about those later, but that's roughly about a year ahead of where we plan to be. Now is the time to be investing in the business, in the infrastructure of the business, to make sure that we're absolutely fit for purpose for the scale of business that we want to be running in several years' time, which is a portfolio in excess of 750 million. And we've reviewed the capital structure already and put in place one that is a cost-effective capital structure for all parties. The outlook, I think it's worth talking about that. When you're in the credit and lending industry, it's important to understand how we place ourselves in the marketplace and why we have the confidence to be feeling that we can continue to deliver the strategy that we started to put in place just under 2 years ago. On our balance sheet, from the 276 million of portfolio, we have 53 million pounds of income, which will unwind to the income statement as we sit here today over the next 3 years. So that gives us a certainty of earnings and delivery of profitability that is already sitting there on our balance sheet. We've got a credit model that's been operating through many credit cycles. We've got a credit model that is largely unchanged over the last 10 years. So certainly this climate requires prudent and sensible terms when in underwriting. So close attention to loan to values, close attention to proper rate for risk modelling, and proper attention to what is truly a prime credit, and not a dash for volume just for volume's sake. And you'll see later on that we're very focused on profitability, not just scale. If we were interested in scale, you'd see us in the residential mortgage market, a very easy way to build your book with large balances that are there for 25 years, but the net interest margin on them is very low and the profitability is almost non-existent. You've got an experienced management team that have been around for over 25 years, and our business model is robust in all respects. So we've got a sustainable growth model through a low and relatively small market share, of course, of the size of the business. So even in our existing markets that we've been in for many years, we only have 3.5% of the market share, so plenty of room to grow. So it gives us confidence in delivering volume and growth. We have new diversified income streams, giving us strength across our income statement. We have adequate capital headroom now for 2 to 3 years, which leaves us well placed. And of course, best of all, we've got access to the retail deposit market with the cheap cost of funds of 2% that comes along with that. So that leaves us well placed for today, and it leaves us well placed for the future for whatever is really thrown at us when it comes to Brexit, trade wars, slowdown of China, slowdown of Europe, whatever you want to throw at us. We think from the position we're standing at today, we can certainly continue to deliver on our strategic objectives. And there they are. Anyone that knows the company and has been keeping an eye on us, you'll see that delivery of and execution of our strategy has been pretty flawless to date. We're happy to put metrics out into the marketplace, and we're happy to tick them off as we achieve them. The capital structure's in place, the plan continues to deliver, the EPS is strong, we're focused on net interest margin and return on equity targets. The initial portfolio of 350 million that we set ourselves 2 years ago is in sight, a year ahead of target. We focus ourselves on delivering a quality portfolio with an impairment charge of less than 1%. We'll continue to focus on that. And even in the short period that we've been in the prime marketplace, already in excess of 25% of our portfolio is firmly in those prime credit grades. We're investing in the business for the future, strong investment in computer systems, IT, operating model and infrastructure in general. We're confident in the business model for the reasons I gave you before as to why we're well placed. And there's our targets that we've set ourselves going forward. Return on assets, which is a great one to lay out for people because it gives them an easily measurable target against our portfolio size. So at 350 million, which is our short-term target for portfolio, that's in excess of 10 million of profits. And at 750 million, which is our next target, that's 20 million of profits. We do pay a dividend. We didn't declare one at the interim stage. We just pay one final dividend payment. For a company that's raising capital and needs capital to grow, it doesn't make sense for that to be an aggressive dividend. We'll always be low yielding, but we also understand the importance of the discipline of a progressive dividend policy, and we'll continue to deliver that. And there, once again, reinforcing our portfolio target of 750 million and a return on equity of 15% by September 2022. And delivering both of those at that point in time, I think I would actually, more than think I know, would probably put us in a superior return category for a small specialist bank. So I think that's it from me. Open myself up to questions.
Thanks for coming to talk to us, Scott. I was wondering if you could confirm with the current level of equity and the Tier 2 bond, what level of portfolio would the company be able to support?
It will slightly depend on how we build that up. As it stands at the moment, it won't take us quite to 750. It will take us just short of 750. So somewhere towards the end of 2021. But also, to get to that point, we need retained earnings feeding through to the balance sheet as well. So that would require us as well to have delivered retained earnings over the next 2 to 3 years. What's more likely to happen is that we'll identify a new opportunity between now and then, which may well accelerate that process and may well require us to return. But just on a static, organic growth plan, it would get us to somewhere around 680 to 700 million of portfolio.
Thank you. And just following up on that, in terms of opportunities, I'm assuming you're talking about something like Azure or...
Yeah, it could be a number of things. I've already mentioned what it's probably not likely to be, residential and commercial mortgages, because we don't think the return is adequate, and it certainly doesn't match our target returns on net interest margin. Yes, there are opportunities out there. We're seeing them all the time. As I stand here today, we're not actively pursuing a strategy of looking for further diversification. With 2 new diversifications in the 6 months, we've got plenty to go on with. We've got 2 excellent new business lines which we can grow into. But I think further opportunities will present themselves. I think they'll be complementary to either the consumer space or the business space, complementing our portfolio. And my vision really for the bank is, by the time we get to 2022, we'll be quite mature in our existing markets of consumer, motor and SME. So we will need new business lines sitting alongside of them. I fully expect bridging finance to be one of those, and you'll probably see another 1 or another 2. But I'm driving for a business that has 4 to 5 sizable business lines. For each business line, you've got governance, framework and costs involved in operating the business model. So 5 sizable business lines would be the way I'd like to deliver a 750 million portfolio.
Scott, can you just clarify the 276 million loan book and the 204 deposits? Is that as at 31st March or as at today?
That's at 31st March.
Can you tell us what they are now?
The portfolio is just short of 290. I can't give you the loan book, but I would imagine somewhere just south of 210.
You've made it clear that you're expecting to return to the market to raise equity, albeit perhaps a few years down the line. And
yep.
sort of refreshingly open that the openness is refreshing. But at the raise in March, that was done, I believe, at 30p, when the prevailing market price at that time was 36p. So that was a very heavy discount. With that kind of history and the openness about needing to raise in the future, do you think that is likely to hold the share price back in the interim?
Yeah, I would hope not. I would think what's more likely to hold the share price back in the interim is the general feeling about financial services and banking stocks. I think we need to recover a little bit of confidence in that sector. Certainly some of our competitors aren't giving us great headlines in the papers regularly at the moment, and I think that time will change. But I'm not trying to dodge your question there. The previous fundraise back in March 17 was done at a 5% discount, which I think is exactly in the slot where we should have been. And the discount of 12% or whatever we had in March this year really just reflected the appetite of the market for investing at that point in the cycle. The question we got from people, which is a completely sensible one, is we can fully understand why PCF wants to secure their future and their strategy for the next 2 to 3 years, but why should we be investing ahead of the uncertainty of the 31st of March? And that's a decision we had to make as a board. In hindsight, we've kicked the can down the road, haven't we? So maybe it might have been better to go in May, but who knows what's ahead of us in October. And certainly, as I stand here today, I would have preferred it to be at a better discount. But having that in place and having that in the bank and having our strategy secure means a lot more to me. And that's why I've worked so hard to put a Tier 2 facility in place, which is effectively a backup capital facility at a after-tax cost of 6.4%, which I think is a pretty attractive option for something that you can dip into as required. So quite often a tier 2 facility is something that you go out and you raise in the market just like you would an equity raise. So you'll get all 20 million at 8% as a drag on your earnings. We don't get that. We've got a very small non-utilisation fee, and we can dip into that, and we don't need to dip into it for a couple of years, and we won't take that cost on board until our growth requires it. And I think I like to be open about the strategy. I think to grow our company, I think people realise we're capital intensive, so it only makes sense, and you can't hide the fact that equity is a very important part of our business. But I think if you go back and track our figures, you'll see that after the last equity fundraising, before it, our ROE was 13%. Immediately after, it was 8.7%. By last September, it was 10.4%. Today, we've delivered 11.7%. You can see that we've utilised the capital wisely, and we've delivered on our ROE target moving forward.
A couple of questions, if I may, Scott. Firstly, what is your net interest margin and what's its sensitivity to base rates? And secondly, how large is your debt and asset recovery team?
Okay, the first one, net interest margin, there was a slide up here on it. It's currently 8%. It fell by 0.5% in the period. That's fully expected. We're targeting 7%, which is a superior NIM. It's certainly the only sort of net interest margin you would only get from operating in specialist niche areas as we do. You wouldn't get it from the products I mentioned earlier. We think it will trend towards that 7% over a 2 to 3 year period. Sensitivity to interest rates, where we eliminate all that risk through a natural hedge of fixed deposits. So what we've got on our liability side is 2 notice accounts, which are 100-day and 180-day, 1, 2, 3, 5, 7 year deposits. And on our asset side of our balance sheet, and that's fixed term, fixed rate. On the asset side of our balance sheet, our bridging is 6 to 18 month lending. You've got the consumer motor, which has an effective life of about 28 months. Then you've got Azul's finance, the broadcast equipment at 3 years. You've got SME asset at about 5 years. And then we do some specialist assets in the leisure market as well, and brand new coaches, which tend to go out to about 7 years. So we've got a perfectly matched book there. And wherever we do have some exposure, we would use interest rate swaps just to eliminate the last little bit of interest rate risk. Credit control department is 14 strong, 15 strong. It's made up in 2 parts. A number of the staff are still collecting out some small balances, which are almost becoming immaterial now, left over from the last credit crisis. That's how long these things can take to collect out. That's because you may well have a judgment and that person has the right to pay £100 a month over a long period of time. We still do that. We don't sell those debts. We're achieving 75p in the pound on that, and you certainly wouldn't get 75p in the pound selling it in the marketplace. The frontline team, who are collecting our main portfolio, makes up the bulk of those people, and that's about 11 people. Just to give you a feel, lot smaller business. Back in 2009 to 12, we had a collections team of about 17 or 18 people collecting out our book and making sure that we remained profitable through what was probably the deepest economic downturn I've ever experienced.
Yeah, could I just ask you, as a non-bank person, a bit about how you think about competitive advantage and strategy? So, as a small bank, I assume there are a lot of bigger banks and other similar banks. So you have to watch your cost position. So you talk a bit about that, so just make sure you're able to weather the downturn if there is one. Secondly, on the revenue side, how you choose where you go, which customers within those sectors, what criteria you use to make those choices, and then having made those choices, you've mentioned you go for the high margins. What is it about PCF Bank that's distinct and differentiates the organisation from other very similar organisations?
Yeah. I think the key for us is identifying the markets that you can operate in that can deliver your net interest margin target. Consumer motor has always been able to do that. Yes, the motor industry per se isn't getting great headlines, but certainly if you look at most of although Pendragon's numbers weren't particularly good today, but if you look at most of the motor companies, you'll see that new car is the real pinch point. Used car is holding up quite a lot better. It's identifying those markets where you can get that target blended rate. Now, we lend a range of interest rates, and we apply a rate for risk model across all our businesses. So at the lower end, you can borrow off us if you're a prime credit for just a bit less than 5%. And if you're not a prime credit, which is the near prime market, which we used to operate in, which we haven't turned our back on, it's just that we, as a proportion of our total business, it's a lot less now because we've grown so much, you could be paying 18%. Still well short of a credit card sort of debt, but certainly higher. Across our whole book, we're looking for a blended rate of about 8 or 9%, plus you have fees. So that's how we get to our NIM. So it's about identifying your product, it's about identifying your market. That's what attracted us to Azul. It's a niche product class in a niche market that can make our net interest margin. Likewise, that's why we're in bridging property, not in commercial mortgages, because once again, it can make that net interest margin target. You're right, there's a lot of cost in being a bank, there's a lot of competition in those marketplaces. We're by far, we're a long way off being the cheapest in the marketplace. So there's still people lending out there at 3.5%. We don't try and compete with them. We don't take anyone on from a volume point of view. We focus on getting the returns we want in the market we operate in. And why do people deal with us? For the customer experience that we offer. So on our two traditional markets, it's the relationship with the brokers, it's the ease of service. A broker is all about getting a transaction off the marketplace quickly. If they don't, another broker might nick it or the person might go somewhere else. So you offer them a good service, you give them a quick answer on the underwriting, and you pay out that transaction in a very fast manner. That broker will come back again. And he'll come back again even if you're not paying the highest commission, because what's more important to him is earning some commission, not losing the transaction. So our USP is about good customer service. It's about using technology as well to leave us at the leading edge of the customer experience. And we've delivered that on the other side as well, where we're getting excellent feedback and excellent reports from retail savers. You can have your account funded with us in 7 to 8 minutes with no further documentation to be actually sent in.
Can I take one quick one from the back, and then I'm going to have to stop it and take more at the break.
Your principal investor, Summers, is named after Sir George Summers, who sailed from Plymouth, telling the crew and investors that it will be a smooth journey across the ocean to the Georgia colonies. He became the first Bermudan when he was shipwrecked in Bermuda, having not had proper risk management. Would you say there are any parallels with the business that you're in with consumer finance? Many people many companies over a period of time have had great difficulty in consumer finance, and with a credit downturn, the business may not be the smooth sailing that you portray it to be.
Yeah, and I accept that. And the reason I put that page up there and headed the question off up front is because it's absolutely sensible to ask how our lending business is going to survive a downturn in the credit cycle. And that's clearly what we're in. And for all those reasons, I think we're well positioned. Now, I'm not saying that our arrears won't increase, and I'm not saying that our impairment charge mightn't go up a little bit as well. We've experienced all these things before. Back in 2009-10, we had the worst impairment charge that I've ever had in the history of being in financial services. It was a 5% impairment charge. We're at 0.9% today. I don't expect to ever reach that again. But even in those days, we were still profitable. Yeah. A good spread of risk, a good understanding of the risk profile of your customers. So we were both profitable and we didn't breach any banking covenants. And there's not many financial services companies that were able to say that during that period in time. So yes, my analogy would be more around choppy waters than a shipwreck, I would think. But we're prepared for it, and certainly I think compared with a lot of the new entrants in the market, having experienced it before, I'm a founding director of the business. I've been through many a credit cycle. I think we know how to collect out a book as well.
Scott, thank you very much indeed.
Thank you.